Hello, everyone. Welcome to this edition of the Manufacturer's Efficiency webinar series, where this week, or this month, I should say, we'll be talking about merchant services fees, payment processing, and there's a lot that goes into that. We're going to get into some of the details of it in just a little bit. But before we get started, my name is Rich Bello. I'm a strategic partner with Schooley Mitchell based in Lawrence, New Jersey, and joined by my partners in this series, Gina Tabasso, the founder of Barracuda B2B Marketing, and Matt Wiseman, who's a certified exit planning strategist and business coach with Focal Point Business Coaching. We do this series on a monthly basis throughout the year. We've been doing it this will be a full year now. We started back in December of 2024, and we're excited leading into the new year in 2026 and some exciting things that we have planned moving forward. But to get to the topic of today's webinar, like I said, we're talking about merchant services, and this is a general agenda of what we're going to cover today. There's a lot of things that go into merchant services. It's, I think, sometimes intentionally confusing with the various rates, structures, and fees, and everything that goes into the way that merchants get charged by their payment processors just to accept credit card payments. And I'm going to try and get to some of the bottom of that stuff today, and ways that you're able to limit your expenses in this particular category. So to start off, we'll talk about rate structure, and there's essentially two different types of structures that you can be charged for accepting credit card payments from your customers. The first is called fixed rate, and this is where you basically get one specific percentage from your payment processor that you pay the processor based on all of your credit card sales over the course of usually a given month. Each month you'll pay whatever that fee is. Say it's 3% is your fixed rate. Say you do 300, or say you do 100,000 in credit card sales in that month. You pay 3,000 to the processor for using their platform to accept payments from your customers. So it's very simple, very straightforward. I think that's probably the biggest appeal of that structure, is that it's straight to the point. It's easy enough to understand, and there aren't too many holes in it. It is what it is, and there's not much to be done about it other than negotiating that specific rate. But that's the extent of it. The second way, I think, is probably the most popular structure, and also by far the more complicated of the two. It's called Interchange Plus, and basically that's a combination of the interchange rates, which are what the credit card companies, the brands charge. So Visa, MasterCard, American Express, Discover, they have specific rates. And then the payment processors themselves, which is the vendor that you would be working with as a merchant, they charge the plus part of the Interchange Plus, and that's essentially their profit margins. And there's a number of things that go into that, which I'll get into in another slide. But the plus portion is where there's the biggest room for opportunity in negotiation and getting better rates and saving more money. Generally speaking, from what I've seen in my experience and in the business that I'm in with cost reduction analysis, the Interchange Plus structure is where you're going to find the best rates, the best potential for savings, the best bottom line in terms of keeping as much of your revenue that you're making from credit card sales as possible in comparison to fixed rate structure. And then third on this slide is per transaction fees. This goes along with the Interchange Plus structure. So again, with fixed rate, you're going to have one percentage, and that's what you're going to pay, that percentage of your total credit card sales. Interchange Plus, like I said, it's the rate that the credit card brands charge plus the processing or the processor's rate for their profit margin, And then usually they'll add a certain charge per transaction that you do. It's usually like anywhere from between, I would say, 5 to 25 cents in general that you get charged for each transaction that's made, in addition to the percentage that the card brands are taking and your processor is taking. So those are the three main structures. Again, like I said, Interchange Plus is usually the one that we see the most frequently. It's also the most easily confusing, I guess is the best way of putting it, because a lot of times what will happen is these payment processors, which I'm sure as a business owner or someone in finance at a company, you probably heard from a lot of payment processors. They are rather aggressive when it comes to their prospecting and trying to bring in new clients. You probably hear from one pretty frequently. And what they will often do when they're making their sales pitch is they'll give you a percentage similar to what I was talking about in fixed rate, but that percentage that they give you as their sales pitch is your best possible rate that you could possibly be charged. And that comes into the type of card that your customer is using to make that purchase with you. So if it's basically a general card without a lot of rewards included in it, you're going to pay a lower rate to your processor because there's not as much that has to go back to the customer, like I said, with rewards. Whereas if you have a business-to-business credit card that has high rewards, that's going to cost a lot more to you as the merchant in terms of the fees that you're paying back to the processor. So that's where it can get confusing because you're pitched one rate on an Interchange Plus, but you end up paying a completely different one. We had an example of a client that we worked with. It was a machine shop. They were promised a rate of 3.86% in an Interchange Plus system. They ended up paying, they were promised 1.9%. They ended up paying 3.86% on 15 out of the 17 transactions because the type of card that was used was one with higher rewards. So that's where it gets very confusing. And it takes a lot of really looking through the statements and the terms of the contract with a fine-tooth comb to make sure you're really understanding what it is that you're paying for. This chart is a bit of a breakdown of where the most opportunities come to get the best rates from processors. And the levels are essentially broken down by the amount of information that you're collecting from the customer in a sale. So you see with level 1, basic transaction details. So the amount of the purchase, when it was purchased, and information about you as the seller, the merchant. And that's not going to generate the best rates because there's a lot of unknown essentially associated with that type of transaction. Where you go to level 2, you're starting to incorporate more data. So the tax amount, customer codes or purchase office numbers, and the zip code that you as the merchant are located in. All that data provides more background and safety essentially to the processor so they could then offer you a better rate. And then once you get to level 3, there's even more details. You're talking about product codes, line item details, and that's where the savings could really come into play. So essentially, the best thing to take from this slide is the more information collected as part of the transaction, the better you'll fare in terms of the rates that you're paying to your processor. The next item that I wanted to talk about here in regards to payment processing are other fees. So we talked about the Interchange Plus structure and how you have your card brand fees plus the markup essentially that the processor is charging. These are some of the things that are included in that markup. So your transaction risk fee, that is dependent on the type of product that you're selling, there could be a transaction risk that's initiated by the processor because they feel like there's greater risk for chargebacks or faulty payments, cards being declined, things of that nature. This usually will come into play with things that, of course, are higher risk. So oftentimes I'll see this with cannabis distributors, or if it's gaming of any sort, games of chance, or like casinos, for instance. They're going to have higher risk. They're going to get charged higher rates because of that risk. The second item here is safer payments fee. You might be familiar with PCI compliance, hearing that term, something that you usually have to do. It's a questionnaire that you fill out once or twice a year to make sure that the way you're processing payments is in line with what the processing industry deems to be the safest things and practices. The safer payments fee essentially is where the processor says, we'll make sure that you're handled and covered for PCI compliance on your behalf, but we're going to charge you a little bit extra to do that for you. So some people may think that that's worth it, so they don't have to worry about it. But if you have someone that is at least generally familiar with the way that you're processing and how you're taking payments and how your system is set up, you could probably do that on your own and avoid that fee. The third thing that I have here is gateway fees. That's kind of another catch-all term, if you will. It could include any types of things from using the software that the processor provides for you to take payments to more custom things, such as they call them intelligent suite fees. And that's essentially a whole separate website that you need a separate login to get to. And it gives you a little bit more detail on your customers and where they're coming from. Honestly, from the clients that we've worked with, most of the time, if they have that, they never use it. So it's not really a necessity, but again, another way that processors can add an additional charge and improve their bottom lines. So the third part is the way that you're receiving payments, obviously by credit card, but exactly how you're taking that credit card information. The first item on the top of the list here, physical terminals. And that's, I think, what everyone is pretty familiar with. You walk into any store or restaurant, they have a credit card swiper. You give your card, or you insert the chip, or it's a digital payment. You flash your card or your phone. That's a physical terminal where the payment is taken in person. The actual card is there, and there's less opportunity for theft or copying a card or stealing a card. That's why the physical terminal method is the lowest risk and the lowest fees associated. Another thing that we have are virtual terminals, and that's usually where you don't have a swiper, but you're taking orders over the phone usually. And the customer is giving you their contact and their payment information. You're entering it into a system, which is that virtual terminal. As the merchant yourself, you're entering their payment information. So that's another way that you could receive payments. And then the last two, I think, are probably maybe with virtual terminal as well, but probably the most common amongst manufacturers in terms of how you're receiving payments. The hosted payment page, that basically means that you have a website outside of your own company's site that clients get directed to when they're browsing your inventory and they want to make a purchase. They get directed to a hosted payment page where they actually enter their payment information and check out that way. And then e-commerce, that's essentially where you have the shopping cart software embedded in your own website, or at least your branded website if you're using a party like Shopify or something like that, where they set up the shopping cart and put it with your branding. So that's how e-commerce works in differentiation from hosted payment page. With these, of course, there's varying levels of fees. And like I said, the physical terminal, usually you're going to see the lowest fees. And then as you get into the online portals, there's more fees associated, and especially ones that are snuck in that don't necessarily do much or are necessary for your business. So that's where you need to be on guard and look out for being overcharged. So we kind of went through the different rate structures and fees that are associated with processing payments. So when you want to talk about lowering those fees and how you go about doing it, it's basically you're putting together an internal cost procurement plan, and you're trying to optimize what it is that you're paying your processors as best as you possibly can. And the number one thing, and it always starts with this, regardless of what business expense you're trying to optimize or reduce your costs on, you want to know what it is that you're paying and what you're paying for, like why you're paying what you're paying. So in the case of merchant services, it becomes very very specific and very detail oriented because as I believe I mentioned earlier, there's so many different card types that a customer can be paying with that you need to account for. And each of those cards has a different rate attached to it. So when you're doing your research and looking at historical data on the types of payments that you've received, the types of cards that you've gotten payments from, you want to keep track of all that stuff. A lot of the time in manufacturing, you're dealing with other businesses as your clients. They oftentimes will have those B2B cards that have high rewards. So you want to keep track of that and see, if we did, say we did 5,000 transactions over the course of a year, if 50 to 60% of those were done on B2B cards, that's a great data point to have and to keep track of, so that you know that that is where that expense is coming from. And the same goes for all the different types of cards. You want to know what types of cards and what fees are associated with those cards, because then that leads you to step 2 on this slide, which is negotiating better rates. So even if you've been with your vendor for a long time, it doesn't mean that they've kept you optimized that entire time. But if you can go when your contract is up with your payment processor, if you could go to them with the data saying, hey, 60% of the time we're receiving payment with these B2B cards, we need a better rate for those cards. So what can you do for us? And you might have to speak to some other vendors, some other payment processors as well, so you can have that data in hand as well, and bring it up to your incumbent to make them offer you a better rate than what you're currently getting. This is what we had just talked about, making sure that you know what it is that you're paying for and how it breaks down. So like I just mentioned, you're going through the different card types, you're looking at all the additional fees, those gateway fees that I talked about, trying to determine if they're necessary or not, is going to help you in your optimization process. Like I was just talking about, talking to the suppliers. Again, it doesn't mean that you're necessarily going to leave your incumbent supplier, your merchant services provider, but you do want to know if what they're offering you is best in market, or at least comparable to what else is out there in the market. Because if not, you could be leaving a lot of money on the table. See it in a lot of different cost categories. I think payment processing is one of the biggest culprits, where they'll auto renew an agreement without much notice, and they'll raise their fees without any discussion with the merchant. So it's something to keep an eye on. It's something to mark in your calendar, usually about 6 months out from the end of a term. You want to have that conversation and start seeing what can be done to improve the rates that you have, or at least to keep them steady and make sure that the payment processor isn't planning a huge hike in your rates. And then once you do all that, once you get a new agreement in place, knowing what your rates are across all those different cards and all of the additional gateway fees, you want to have essentially a chart with all that information. And then each month when you get your statement, your invoice from the processor, and you see the types of cards that were charged, make sure that the rates that you're being charged are in line with what that agreement says, because we've seen it before a lot. Sometimes the cards are not being charged the proper rates. So you have to keep an eye on that each month to make sure that you're getting charged what you're supposed to be charged, so that all of this work, all the research and the tracking and the negotiations are actually working to your benefit, and you're seeing the reduced costs that you worked for in what is actually being charged, or else it's all for naught if you just let the processor charge whatever they're going to charge unchecked. All that being said, it's clearly a lot of work, and a lot of times a lot of companies don't have the manpower or the time to dedicate to that process and keeping track of everything on an ongoing basis to make sure that everything's in line with what your contract says it should be, and negotiated rates that you had earned. It's a time-sensitive thing. So this is part of what we do at Schooley Mitchell. We do all of that for our clients, so they don't have to worry about it. We keep track of everything. We look over the invoices each month with a fine-tooth comb, make sure the rates are being applied properly. If they're not, we work with the payment processor to get credits or refunds for our clients, so the client doesn't have to worry about it themselves. So what I have here is just an example of one of our clients in the manufacturing space that we've helped with their merchant services. It was an acoustical treatments manufacturer. We looked at both their merchant services and their wireless devices, the bills on those. And these are the results. They were spending just under $30,000 a year on their merchant services fees. We saved them $21,000, over $21,000 on those fees, 73%, based on the structure that they had and what we were able to get them with a new agreement. So that was obviously significant, in addition to about 20% saved on their wireless devices. So in total, we were able to save this particular company about $23,000, or 63% on what they were paying in these two areas. Just a little more about Schooley Mitchell. We've been doing this type of work for over 20 years. We're coming up close to 25 now. We are the largest independent firm in North America that focuses specifically on this cost reduction process. We don't have any types of deals in place with any vendors, any merchant services providers, or any telecom companies, or any of the other cost categories that we consult to. So we have no reason to push our clients to one particular vendor. We're always looking at what's going to be in the best interest of our client, what's going to save them the most, while also providing them with the best service. It's not like we're always going to recommend a client switch to a bargain basement provider. We vet all of the providers before we recommend them to anyone. You can see here we're at over 300 different franchisees in the Schooley Mitchell network throughout the US and Canada, and we've documented over $1 billion in total savings amongst over 30,000 clients. This is a bit about our process, the way that we do it. First phase, we're talking to a client to discover how they use whatever service it is that we're looking at for them. In this case, today we're talking about merchant services, payment processing. So we're going to find out how they're processing, whether they have a swiper or they're using a virtual terminal or e-commerce, some of those things that I talked about before. We want to get to the bottom of exactly what our client is doing. We're going to look at some of their historical invoices to see all of their rates. And then we'll go to phase 2, which is negotiating with the vendors. And we'll always include the incumbent vendor. That's our top priority, to keep the client with the incumbent so they don't have to switch anything. They could operate the same as usual, just spend less money on that particular expense. Phase 3, we present the proposals that we've gotten, our recommendations as we call them, for savings to our client. And then the client makes a choice on what is best for their business, either one of the savings options that we present, or deciding not to go with any of them and just sticking with what they currently have. That's totally up to the client to decide what they want to do. And then the last part is, if they do decide to move forward with one of our recommendations, we'll be right there by their side throughout the implementation process. We'll do most of the work on their behalf and get things up and running for our client as quickly as possible. To summarize the things that I talked about today, as I mentioned multiple times, merchant services is a very complex cost category for any business that's taking credit card payments. Lots of details to look at. And if you don't have the time for it, it's almost impossible to do and really understand. The rate structure that you're on for your particular business is what matters the most, because it could be a great rate structure for a brick and mortar that's taking all payments with card present. But if you're not doing that, then it's probably not the right rate structure for you. And then the last point here, just again, harping on the fact that this stuff does take a lot of time to get right. And it's something that we offer on behalf of our clients so they don't have to worry about doing it. Here is all of our information. If anyone's interested in scheduling a discussion with any of us, you'll see our QR codes are there. So those will take you to our sites and the ability to schedule a request for a meeting with either of us. So feel free to do that. And then just some upcoming topics we're going to be discussing as we get into the new year. Gina's going to be talking about accelerating the sales cycle and not burning out your team in January. And Matt's going to be talking about strategic planning and how it leads to efficiency in February. And then I'll be back in March to talk about something that I hinted on here earlier, which is telecom and the different fees that are associated with that and how you can relieve some of those. With that, we always end these webinars with a brief discussion amongst ourselves for any questions that Gina or Matt may have come up with. Also, you'll see the contact information for myself there on the screen. If you have any questions, feel free to reach out to me, and I'd be happy to set up a discussion.
As always, Rich, very informative. Like, I learned some things I didn't know. And it caused me, actually, while you were talking, I went and Googled my bookkeeping software, what the charges are, because I thought it was 2.9%. But I found out it's 2.9% plus 60%, 60 cents per transaction. Mm-hmm. So I'm not on that flat rate that I thought I was. And then I really loved where you talked about, I didn't know this either, that depending on what type of credit card the customer has, that could change the rates that you're charged. I had no idea. I'm a B2B business. I didn't know that if I accept a credit card from you and a credit card from Matt, there could be different fees charged to me based on what credit card both of you are using. So that was really eye-opening for me. Thank you.
Yeah, absolutely. All these rewards, and it's great. It's a great pitch by the credit card companies about, cash back or miles or whatever the rewards may be. Someone has to pay for them, and it's not the card companies and it's not the banks, it's the merchants. So that's where it gets to be a little bit tricky. And like I said earlier, you kind of have to just be aware of that and make sure that you're doing the best that you can to get good rates for that stuff, and make sure that you're protected.
Yeah, very eye-opening, Rich, as Gina said. And so I'm curious, are the typical merchants, are they willing to share the data from your transactions down to that level? Because a typical, look, I'm thinking about my own, credit card statements. I mean, it shows a list of transactions and the dates and the amounts, but it's not showing, not necessarily showing the type of card used. I mean, is that something that most merchants will share automatically, or you've got to kind of, put in a special request to say, hey, I want to see, this level of data with all of my client transactions?
Yeah. So the merchant is the company that's taking the payments. The payment processors are the ones that collect all of that data. So they have it. When they send an invoice to a merchant, any company that's taking payment via credit card, they usually, from the ones that I've seen at least, they will always have the breakdown within that statement. It's just the fact that the statement is, depending on how many transactions you're doing, it's 4 or 5, 8 pages long. Most people just want to see the top line numbers, what they made and what they're being charged. So if you scroll down further on the statement from the payment processor, they have that information. Separately, though, what I was talking about earlier in terms of the information collected from the customer, that's something that the merchant can control, what they're collecting when they're taking a payment. They can make sure that they collect additional information if they're inclined to do so to try and get better rates.
Got it. Really interesting. Yeah, thank you.
It's something that before I started in Schooley Mitchell, I had no concept of whatsoever. And it's definitely something that I've learned a lot about in the years that I've been doing this. And I think that's probably the case for a lot of people that are dealing with processing payments. They get the invoice, they see the amount that they were charged. Usually they don't even have to make a payment. The payment is just withdrawn from the revenue that goes back to their bank account from the processor. So they don't really ever think twice about it. It is what it is. And, unless you dig deeper, you're not going to know what it is and where it's coming from. Right. Well, if you guys don't have anything else, I appreciate those questions, but I definitely we all appreciate everyone that tuned in for this webinar today. We hope that you enjoyed it. We hope that you'll join us again in January in the new year, and we wish you the happiest of holidays, a happy new year, and we'll see you back in 2026. Thanks, everyone.